Social Security is running out of money. You know that little bit of money that's going towards your Social Security taxes? Well, that Social Security money that you're paying isn't going to fund your retirement, it's going to fund somebody else's retirement. So when it comes time for you to retire, well, there might not be much money left. What's up, everybody? I am Jaspreet Singh, and if you want to retire in the next 10 years, even if you have nothing today, you need to have the right plan in place, and that's what I'm going to be going over today. So let's jump right into it. Being financially free or wealthy means you have enough cash flow coming in from your investments and assets to cover your daily expenses. Now, the problem with that is when most people talk about creating this cash flow, they say one or two things. Either you got to go out and just buy some cash flow producing real estate, or you got to buy stocks that pay dividends. The problem is, what happens if all of your tenants stop paying rent? What if the government introduces some new moratorium so now your tenants don't have to pay you rent? Or what happens if the stock market crashes and companies slash their dividends and you were relying on this one stream of income? This is why you need to know how to invest your money. Nobody can predict the future. Nobody knows what's going to happen tomorrow. But what you need to do is be financially educated and prepare for anything. I love real estate, and I also love stocks. But I also know that nothing can go straight up forever, and every asset class goes through their own cycles. Sometimes real estate is going to be producing cash flow and make profits hand over fist. Sometimes it's going to be the stock market. Sometimes it's going to be other places. So what you need to do is, instead of trying to guess what is the best thing to do, you need to be the person that's financially educated and can win in any economic situation. So if you never want to have to worry about going to work to get another paycheck, then there are 7 investments that you need to make. That way you have money coming in even if the economy is booming, even if the economy is going sideways, and even if the economy is crashing down. The first investment you need to make is in real estate, but not just any real estate. Cash flow producing real estate. This is not the home that you live in, and this is not a home that you're going to flip. Because when most people talk about making money in real estate, they assume that you have to buy a home like this, and let's just assume that you buy this home for $150,000. And now the way that you make money, people assume, is you have to hope that you can sell this property for $250,000 so you can walk away with your $100,000 check. Now, this is great. If you get this type of appreciation, that's fine, but I want you to get paid while you wait. So what I want you to do when we talk about owning real estate, and more specifically cash flow producing real estate, what you need to do is you want to buy this property, something like this, for $150,000. And now what you want to do is, instead of just trying to sell it for $250,000, you want to take this property, rent it out to somebody else for $1,500 a month. So you move in a family who is going to live here, and in exchange for them living in this asset that you own, in exchange for you giving them this value, which is the home, they're going to pay you $1,500 a month. Now, I know some of you might be thinking, $150,000 for a home? Where in the world am I going to find a $150,000 home? Well, if you look outside of your city, and maybe if you look outside of your state, you will be able to buy a home for $150,000, even in today's market, that you can rent out for $1,500 a month. I have done this many times. So this is very possible, and now you will have a tenant that's living in this property that's not only paying for your home, they can help you pay for your mortgage, they can pay for your taxes, they'll pay for all your expenses, and they'll put some money in your pocket every single month. Now, real estate investing isn't easy. Every real estate investor has to go through hurdles. Every real estate investor has to go through roadblocks. There is a learning curve that you have to go over, and it's tough because now you got to know the real estate agents, you got to know the contractors, you need to know the attorneys, you need to know the building inspectors, you need to know the city officials. So there's a lot of people that you have to meet, and there is a learning curve that you have to go through. But once you go through the learning curve, real estate investing can become much more passive. I own quite a few real estate properties, and I don't manage any of my real estate. I don't know who my tenants are. I have a property management company that manages my properties, and they make sure the tenants pay, they make sure all the bills are paid, and they're the ones that put the checks into my bank account every single month. Real estate is my favorite place to invest because when you invest in real estate, you can produce consistent and predictable cash flow, and you get tax breaks. Real estate offers some of the biggest and best tax breaks that our tax code has to offer. The reason why I know that is because I am a licensed attorney, and although I am a licensed attorney, I'm not your attorney. So if you have specific tax questions, talk to a professional in your area. But real estate investors get huge tax breaks, which allow you to now make this money. At the end of the year, you could have $10,000 worth of profit in your bank account, but because you made this money from your real estate investments, from this type of passive income, you could tell the government, hey, yeah, I made $10,000 worth of profits, but I'm only going to pay you taxes on $5,000 worth of income. So you show the government, hey, I made $10,000 of profit, but I only have $5,000 worth of taxable income. So you're only paying taxes on $5,000, and all the extra money is yours. So you get to pay less in taxes. You get to produce this consistent cash flow that is predictable, and your money is hopefully in an appreciating asset. If you're buying real estate in a place that's growing with more businesses coming in, well, now the value of your real estate is going to go up too. And now you own the asset. So as property values go up, so do rental values. Now you're getting paid while you wait. Instead of just waiting for your property to go up in value from $150,000 to $250,000, you get a $1,500 check every single month. And as property values go up, your rental values will go up too. And so now you're getting paid while you wait. The first property that I ever bought wasn't a home that I lived in myself. It was a small 1,000 square foot condo that I rented out. It was a rental property. I leased it out for $600 a month, and after going through my learning curve, this property started paying me somewhere between $250 and $350 a month in profit, and this was completely passive because I handed over the keys to a property management company and they did all the work. Now, I had to go through a learning curve. The beginning part was not easy. I was spending a lot of time meeting people, learning how the process works, on the phone, even with tenants, trying to figure out how this whole real estate investing thing worked. But once I got the hang of it, now this is putting $250 to $350 in my pocket every single month, and I still own that condo today, and today it's leased for $850 a month. This is why real estate is my favorite place to invest, because now you can stack this income. You can stack the cash flow. So now I started thinking, if every property that I own, every unit, pays me $250 a month in profit, then what I need to do is I need to figure out how I can acquire 10 units so I can have $2,500 a month coming into my pocket. And if I can get 100 units, that's $25,000 a month of consistent passive cash flow coming into my pocket every single month. And if I'm thinking even bigger, if I can go out and buy 1,000 units, that means I'm going to be making something around $250,000 a month in consistent passive cash flow. And this $250,000 a month I can keep in my pocket. I don't got to pay the same taxes that a doctor would on this $250,000, because now I'm making my money from my investments, so I get new deductions, I get new tax breaks that people who are earning their money from their job don't. This is why real estate is so powerful, because not only do you get this cash flow, you get tax breaks, and you can get this appreciation, which is completely passive on your side if you know how to invest your money for the long term. Does this mean that real estate is completely risk-free? No. You saw what happened in 2008 when people who were highly leveraged, who didn't know what they were doing, got burned by the system. This is why you want to be a smart real estate investor and manage your properties smartly and buy properties that are producing positive cash flow, that are paying you to own them. What happened before the 2008 crash was people were buying properties where now they rent the property out and they would be losing money every single month, because the hope was in 2 or 3 years you'll be able to raise rents, and now when you raise rents you will finally be profitable. So people were buying losing investment properties on the hopes that rental rates would rise fast enough over the years that way eventually this property would be profitable, and even if it wasn't, property values were skyrocketing, so you can just cash out, refinance, and pull some of your equity out of the deal. Well, you know how that story ended. That whole bubble burst. So you want to be a smart real estate investor. Own properties with equity in the deal and buy properties that are producing positive cash flow. I'm looking for a minimum 7% cash on cash return on my money, meaning for every $100,000 I invest, or for every dollar I invest, I want to get 7% back every single year. So if I invest $100,000, I better be making $7,000 in cash flow a year. If I invest $1, I better be making 7 cents a year in positive cash flow. The second investment that you need to make if you never want to have to worry about going to work again is you need to own a cash flow producing business. Everybody, if you want to become wealthy, needs to own a business. Now, listen to what I said very carefully. If you live in a first world country and you want to become wealthy, you need to own a business. But that doesn't mean that you need to start a business, and that doesn't mean that you should be operating a business. Actually, most people should not be starting a business, and most people should not be operating businesses. They don't have it in them to run or operate or start a business. But what everybody can do is own a business. The way our tax system in our society works, you get benefited if you own the business, and you get punished if you work for the business. So what you need to do is you need to own a business. That doesn't mean that you shouldn't have a job. Most people should be working. Most people should not be running their own business because they don't have the skill, they don't have the expertise, they don't have the drive necessary and the risk tolerance to run and operate their own business. But even if you don't have that, you can still own a business that's producing cash flow and be the owner of the business. That way you get the benefits of owning the business without having to run it. Now there's two reasons why you want to own these type of businesses. The first reason is for the income, or we'll call it the cash flow in this case. And the second reason are the tax benefits. And depending on the strategy that you have to own these businesses, you can get one, the other, or both of them. The way most people's finances look is you go to work, you get paid, and then you pay taxes, and then you got to spend whatever's left on your vacations, on your car, on your home, and everything in between. But if you have a business, you can kind of flip things around, because now you can spend money using pre-tax dollars as long as it's for the business, and then you only got to pay taxes on whatever's left. Recently, I was just in Chicago, and now I got to go to Arizona and Austin, Texas, and I had to go for business, but they also were kind of like vacations, because now I got to go see Chicago. I'm going to go see Arizona, and I get to go see Austin, Texas. But I get to go there using pre-tax dollars because I got to go for the business, and I get to go there and eat at nice restaurants, which are business meetings, which are, again, pre-tax dollars. And now I get to take this money and tell the government, hey, I made this much money, but I had to go to Chicago, I had to go to Arizona, I had to go to Austin, I had to eat in these places, I had to have a hotel in these places, and now with whatever money's left, that's the money I pay taxes on. For most people, it's flipped. You make money, you pay taxes, and then you would have to find the cash to go to Chicago or Arizona or Austin. And so when we talk about the tax benefits of owning a business, now the benefits that you're getting is you get to spend money using pre-tax dollars, and then you only have to pay taxes on whatever is left. So you want to spend as much of that pre-tax dollars as possible, assuming it's for real business needs, but you have the benefit now and the ability to spend money before you pay taxes. You don't have that option if you're an employee. Second, on the cash flow side, if you own an established business that's profitable, well, now if you own a piece of it, you will get your share of the profits every single year. So now you get your piece of the profits, and you're doing this as the owner of the business rather than the operator of the business. That's why it's important not just for you to work in a business, but for you to know how to own a business. And there's a few ways that you can do that. You can go out and buy a physical business. There's a ton of websites online which show you businesses that are for sale. The key here is you want to make sure you're buying a business that doesn't require you to operate the business. You want to own a business that you can hire someone else to operate it for you. You can buy something like a hotel, or you can buy a franchise. Remember, you want to own a cash flow producing business that doesn't require you to work in the business every single day. You probably will have to spend some time managing the business, making sure that the business is running, but you don't want to be the person standing behind the cashier every single day. You want to own a business that's producing cash flow that you don't have to work at every single day. The alternative to owning the entire business is to own a partial ownership share in a business. So this could mean that you and a few friends are going to go out and buy a business, or you could go out on the stock market and buy shares of a cash flow producing business. That means a business that is profitable. We'll talk more about growth companies a little bit, but this is something that's a little bit more stable. You're not going to get the same tax benefits if you just own stock in the company as if you would if you owned the physical business, but you still do get other tax benefits from the money that you make in the stock market, because the money that you make in the stock market is taxed at a lower rate than the money you make from your job. The whole idea here is you want to invest into the companies that are producing value, that are generating cash flow. So you want to own a piece of the companies, or you want to own the company that's making this money. That way when these companies make money, so do you. The key here is you don't want to be the person operating the business, you want to be the person owning the business. The third investment that you need to make is a passive investment into the stock market. So in the second point, we were talking about making a more active investment in the stock market, because if you're investing in the stock market in number two, well then you were looking for undervalued companies. You were researching companies that you want to own for the long term. Here, I'm talking about passively investing some money into the stock market. That way you have ownership in the economy, and as the economy grows, so does your wealth. So the way that this works for me is I have a pie like this, and I have a few different ETFs in the pie, and every single week money is automatically pulled out of my bank account and it goes into my passive stock market account, and it's distributed into this pie among the different ETFs. An ETF is an exchange traded fund, and it gives you exposure to a whole bunch of stocks. So now instead of me trying to find the best stock for me to invest in, I have these ETFs. I do invest in individual companies, individual stocks like I talked about in number two, but this is a separate strategy that I have in addition to that. So that's money that I already have in the market, and that's cash that I put in when I find a good company that I want to invest in. In addition to that, every single week I have money that leaves my bank account that automatically goes into these ETFs that gives me exposure to the broad general stock market. The whole idea being I'm just putting money into the market because I believe in the future of our economy, and if I believe in the future of our economy, I believe in the future of our stock market. So this is completely passive on my end. This happens every single week, every Wednesday I think it is. Money's pulled out of my account and it goes into the market. Doesn't matter what day it happens. We just want to make sure it's consistent. And now all I'm doing here is I'm building a separate investment account completely passively. I don't got to do any work to let it happen. And every single week, this account grows bigger and bigger and bigger. So this cash isn't sitting in my savings. It's just going right into the market. And as the market grows, so does my account. The key here is what happens if the market goes down? Well, I don't change anything. If the market goes down, I keep letting this thing happen passively. If the market goes up, I keep letting it happen passively. I let it happen consistently and I let it happen passively because now all I'm doing is I'm putting money in the market and I'm letting the market do its thing. I use a platform called M1 Finance, who's also a sponsor of the Minority Mindset, to do this. And the reason why I like M1 Finance is because it's super simple and it's completely passive. I just set that every Wednesday I want money to leave my account. I set which ETFs I want to own, and then every single week M1 Finance will automatically pull the money out of my account and they'll automatically invest it into my pie of ETFs using whatever distribution I want. So you don't have to do 25, 25, 25, 25. You could do 10%, 40%, 50%, whatever you want to do. And you can just set how many ETFs or stocks you want to invest in. And now this is passively investing for you every single week or every single month or whatever frequency that you want. So I like it because how easy and simple it is, and it's an easy way for you to constantly keep investing your money in the market. That way you can let the market do its thing. You can use whatever platform you want. Do your own research, see what you like best, but if you want to learn more about M1 Finance and you want to see how you can start investing your money like this for free, I'll put the link to how you can learn more and start investing with M1 Finance for free in the description below. Minority Mindset is a paid partner from M1 Finance, so if you use them, we will get compensated, but there's no additional cost to you. The reason why this is important is because you want to have some real diversification. When most people talk about diversification, they have no idea what they're talking about. They say something like, oh, I have a growth mutual fund and I have a blue chip mutual fund or ETF, and so I'm diversified. But all of your money is in paper assets. All of your money is in the stock market. So if the stock market crashes or if something happens to the stock market, which can happen overnight, you can see the stock market fall by 50% in just a day. If that happens, well, now all of your portfolio, doesn't matter if it's blue chip or growth or whatever it is going to go down. And so you want to have some diversification. You got to have the real assets like real estate. You want to own a real business, and now you have your passive investments, which give you exposure to the general economy and the general stock market, which we've seen over the last century grow by somewhere between 8 to 10% a year. The fourth investment that you need to own is in growth companies. And number two, I talked about cash flow producing companies. These are more of your established companies that are producing profits. Number three, I talked about owning ETFs. That way you get general exposure to the stock market. This is all about owning the startups, the innovators, the growing companies. Personally, I've been putting more of my time to learn more and starting to invest more into these companies. This doesn't have to be in the stock market. Again, you can invest directly into startups, or you can invest in startups that are new stocks on the stock market. The whole idea here is you want to be investing in some of the innovation because times are changing. Our world is changing. Our economy is changing. Money is changing. And so if you want to be on the forefront of that, you need to own a piece of these growth companies. And there's a couple ways that you can do that. Either you can know these companies directly and you can invest in them, kind of like what you see happen in Shark Tank. So now you own some equity in these startup companies. You can work with crowdfunding platforms, which allow retail investors, regular people, to invest into these startup companies who are looking for investments, or you can look at some of these startups on the stock market. This investment is a high risk investment. So what that means is there's a big possibility that you can lose all of your money. You can invest your money into a startup that thinks that they're going to be the next Amazon, or that thinks that they're going to be the next Tesla. But then they can go completely bankrupt because they don't know how to manage their money, or they don't have a very good product, or people just don't like the company. But the upside with these higher risk investments is you also have the opportunity to make a whole lot more money, because this is one of the few investments where you can see 100x returns, because now you're investing in companies that are growing, that are innovating, and that have the opportunity to grab a whole lot more market share. If you're just starting off as an investor, this is probably not the first place you want to invest. You want to learn the ropes. You want to start generating cash flow. You need to know how investing works. Once you start to build more of your wealth and you're looking for more diversification and you want to be a little bit more risky, then you can start looking here. One of the easiest ways to mitigate your risk is just to learn. You got to learn about how some of these companies work. You need to understand the industry. You need to know where you want to invest. It took me a lot of time to understand how some of these startups work, how to value them, to understand what type of companies I want to be invested in and what industries I want to be invested in. I'm still learning every single day. But this is something that comes with a lot more risk and the opportunity to make a whole lot more money. And this is something that you want to pay attention to as an investment for yourself. The way you make money here is you're buying a piece of ownership into a company while they're still small, and your goal is that they're going to grow bigger and that they're going to be acquired by a larger company, or they're going to go public, they're going to get an IPO, and now you have the ability to sell your shares. So you might be buying your shares at $2 a share, and when somebody comes and acquires this company, or if they go public, you're hoping that now you'll be able to sell your shares for $20 a share or $200 a share. It really just depends on the company. Again, high risk, high potential reward. The fifth investment that you need to own is real money, or otherwise known as gold and silver. Our dollars are fiat currency, meaning they are just pieces of paper that are printed by the government and the Federal Reserve Bank. Now, this is good if you understand money and if you're financially educated, because it creates more inflation, which means if you own assets, if you own the means of production, you get to make more money. It's not so good news for the unfinancially educated, because now you're the one that's paying the price through inflation, also known as a hidden tax. Now, I don't say this to scare people, but if you run into a situation where you print too much money, well, then the dollars that you print become worthless, because people no longer just want to work for paper. They want real money. Everything has a lifespan, from people to economies. And the thing that has caused many great civilizations and many great powerful economies to crash in history has been excessive money printing. The ancient Roman Empire had an economy built off of silver. But then when the government didn't have enough silver to expand their operations, to expand their military presence, to invest into their own community, that's when they started debasing the silver. They started mixing the silver with other metals, and people realized eventually that this silver that they were getting, the fake silver, wasn't real money. So then people wanted more money. And in the beginning, this printing of fake money helped the economy and the civilization grow very quickly, because now the government had access to more money and they were able to give this money to people, and people were willing to work. But eventually, people no longer wanted this fake money, and that's when the civilization came crumbling down. As you're building your wealth, you want to think about having some insurance against your investments and against yourself and against the government and society in case they print too much money, but having some real money, having some physical gold, having some physical silver. This is something physical and tangible that you want to own the real asset of. You want to own the physical gold, you want to own the physical silver. The idea behind these is not to get a huge return on your money. The whole idea behind this is now you have insurance against the worst case scenario type of situation. You have insurance against the economy blowing up, and you have insurance against the dollar just being completely inflated and losing its value. So this is something that you want to have as a hedge, as insurance that you own as a real money. Now, again, there's a time and place for everything. The first thing you want to do is not take all of your extra cash and go out and buy some gold. The first thing you want to do is you want to start generating some cash flow. As you build your wealth, as you build your cash flow, as you become financially free, now you really want to start insuring your wealth. And that's when you need to start owning some of these commodities. And you want to own the physical asset. The sixth investment that you want to own is some cryptocurrency. So the whole idea behind cryptocurrency is it's a movement of people wanting to move away from the fiat currency, from our dollars, because of all the reasons that I just talked about. Our dollars can be easily manipulated by the government, the Federal Reserve Bank, by just printing money. This, you can't really do that so easily. The whole idea behind cryptocurrency is a decentralized worldwide digital currency, meaning it's the same currency. One Bitcoin in America is the same as one Bitcoin in Japan, and it's the same as one Bitcoin in Mexico, and it's the same as one Bitcoin in India. So it's decentralized. You can use it anywhere in the world. Now, at the time of recording this video, you can't just walk into any store and go offer to pay with Bitcoin or Ethereum or Cardano, but you have to imagine that as time goes on and as people open up their minds to cryptocurrency, as people understand the powers of blockchain, that it's going to be much more widely used and accepted. The concern that I have with cryptocurrency is you have a lot of people buying cryptocurrency with the hopes of getting rich quick. When I buy cryptocurrency, my goal is not to see a massive return on my investment. My goal is to own an asset. My goal is to own another commodity, something like gold and silver. It's kind of like another insurance. It's another currency, another form of money that I want to own. And I want to own this for the long term. There's a lot of power and value that you get from the blockchain technology that's underlying cryptocurrency. I'm not going to go over all that blockchain stuff in this video, but the whole idea here is this is the people's money. People are moving towards cryptocurrency because they want to move away from fiat currency. They want to move away from their reliance on the government. They want to move away from the reliance on the Federal Reserve Bank, because these entities, these institutions have the power to manipulate the value of your dollars. They can manipulate the value of your savings. And so because of that, people are moving their money to cryptocurrency. And so that's why you want to have another hedge here by owning some of this cryptocurrency. And the seventh investment that you need to make, that way you never have to worry about getting money from your job again, is you need to invest in your own education, especially your financial education. I spend a lot of money, thousands of dollars every single year on books, on courses, maybe seminars, maybe coaches or consultants. This is money that I am investing in myself, because you have to understand what's going on, and there are people out there that know more than you. So instead of you trying to figure it out yourself, you can just pay someone somewhere between $20 and maybe $20,000, depending on what it is, to help them teach you what it is that you need to know from them. Now, I also want you to be a little bit careful when it comes to investing in your education, because there's a whole industry of people that are selling this whole concept of get rich quick schemes on the internet. That way you get excited about the idea of going from 0 to 6 figures a month in 60 days if you just pay this person $997. If you want to be investing in your education, you need to be investing for a specific purpose. What are you learning how to do? Are you learning how to build a business with e-commerce? Are you learning how to invest in real estate? Are you learning how to invest in the stock market? If so, then this might be something worthwhile for you to invest in. And you want to make sure that the person teaching you is actually doing what they teach. You don't really get that in school. You don't have teachers that do what they teach. These teachers are just teachers. So you want to make sure that if you're paying for education, especially financial education, you're learning from a teacher that actually knows what they're doing and that has actually done what you want to do. This single investment will help you get better returns on every other investment class that I just talked about, because it will teach you how to be a better real estate investor. It'll teach you how to be a better stock market investor. It can teach you how to understand cryptocurrency better. It'll teach you how to understand commodities. It'll teach you how to manage your money. It'll teach you how to be better with your money, how to grow with your money, and how to create new streams of income. This is something that you have to be investing in. That way you can lower your time to learn something, because if you're just trying to do it yourself, you can learn how to do anything. But you can learn a whole lot faster if you just pay someone to teach you what they learned from their mistakes. We're gonna jump back into the video in just a second, but before we do, if you're an investor and you're looking to get better returns on your money, I can help you. I've been investing my money for over a decade now, and what I've learned is that the number one way to make more money on your investments is by actually investing your money and then by learning from your mistakes. But this can be very time consuming and very expensive. That's why the second best thing that you can do is by learning from other successful investors. Learn from their successes and learn from their mistakes. That's why I created Market Insiders, which is an investing education app where you'll get access to top level successful investors in the real estate, stock market, and cryptocurrency space. Every week, you'll get access to group coaching calls where you'll learn how to be a better stock market, real estate, and cryptocurrency investor. So if this sounds like something that would be beneficial to you and your investment portfolio, I'll put the link to where you can try out Market Insiders for free with a 10-day free trial in the description below. The whole concept of a traditional retirement is becoming harder and harder to achieve. Just take a look. And it's not just young people facing this issue. Millions of baby boomers are struggling because they're getting caught in the broken retirement system, according to the Washington Post. The old idea of retirement is after you finish school, you're gonna go and get a job. And once you get a job, you're gonna stay at this job for the rest of your life. So you stay at this job for 40 or 45 years, and then once you turn 65 years old, then you're gonna quit this job, and now you're gonna be able to retire because your company's gonna pay you a pension, the government's gonna pay you Social Security, and now you're gonna be able to sit back and do whatever you want without worrying about money, because you have your pension and your Social Security taking care of you. Nowadays, it doesn't really work like that, because for one, people don't stay at one job for their whole lives, and even if they do, companies don't pay pensions like they used to. And Social Security, well, Social Security isn't what it used to. For one, you never want to rely on the government to take care of you. And second, when we talk about Social Security, the Social Security fund is having its own problems. It doesn't have enough money to keep paying out Social Security at its current rate. That's why you might have heard that Social Security is running out of money. So right now what's happening is every time you get paid, you know that little bit of money that's going towards your Social Security taxes, your FICA taxes, well, that Social Security money that you're paying isn't going to fund your retirement. That Social Security money that you're paying is going to fund somebody else's retirement. So when it comes time for you to retire, well, there might not be much money left. But even if they turn things around in the Social Security Administration and they find more money, so when it comes time for you to retire, you start getting these Social Security checks, chances are your Social Security checks are not going to keep up with the rising cost of living, because right now we're seeing the price of things around us grow pretty quickly, but Social Security income doesn't grow as fast. So this money that you're getting from Social Security is going to be right here while the price of everything else keeps going way up here. So if you want to be able to live off of your Social Security income, you're going to have to really downsize your life. And I don't think that's how most people planned on living their golden years. And you especially don't want to be relying on Social Security because there's also a chance that the government cannot get it together, because we've seen that happen in the past. We've seen that when the United States government starts running out of money, that they stop healthcare payments to their employees. So people that are working for the Social Security Administration and people that are working for the post office, we've seen the Treasury halt payments to them, even though these are people that are relying on this money just because they didn't have any money to pay out. All of these things coupled together with the higher cost of living because of this higher inflation makes it more and more important for you to start thinking about retirement a little bit differently, which is what I'm going to be talking about in this video. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. So the first thing that you have to understand is kind of on a bigger economic level. Right now, we are in an environment where over the next couple of decades, chances are we are going to see higher inflation. What that means is we are going to see the price of things around us grow faster. And so the people that this hurts the most is, one, the financially uneducated, because now you're the one that's having to pay the higher prices, literally. And second, it's people that are living off of fixed incomes or people that plan on living off of fixed incomes. The whole idea behind a fixed income is every single month you have a certain amount of money coming in. So let's say you have $3,000 hitting your bank account every single month, and that's all the money that you have. This is your fixed income. Well, if your expenses are $2,000 a month, then that's no problem because you're making more money than what you spend. But if all of a sudden you're making $3,000 a month, but now your expenses jump up to $4,000 a month because of the higher cost of living, now either you're going to have to cut down your expenses or you're going to have to find a way to earn more money. And if you're 70 years old and you're in retirement, it's going to be a little bit harder for you to go out and find a new way to make new money unless you want to go back to work. What you want to see happen when you go into retirement is the amount of money you're making every single year is enough to cover all of your bills and hopefully keep increasing as the price of things keep going up. So if the price of things go up like this, you want your income to keep going up like this. That way you can keep comfortably living your life. And you want this to happen without you physically having to go to work every single day, because if you're in retirement, the whole idea is you don't have to go into work every single day. For the average person, they're hoping that their retirement will be funded through two different things. They're hoping that their retirement will be funded through Social Security and through their 401k, or I guess their IRA as well. So your tax deferred retirement accounts and their Social Security. This is what the majority of people are relying on, that they hope that these two things together will be able to fund their retirement so they can live their life without worrying about money when it comes time for them to retire. Now, let's start by addressing Social Security, because we already talked about some of the concerns with relying on the government when it comes to money. But there's a couple other things that we have to think about, because now with the higher cost of living, if your Social Security income does not increase with this higher cost of living, you're going to be the one that's having to pay the price. Either you're going to have to find more money or you're going to have to downsize your life. Now, the hope is that Social Security will keep increasing with the higher cost of living, but you have to also remember that the higher the Social Security grows with this payouts, the less money that they're going to have left in the Social Security account, because now they're having to pay out more money. So now as the cost of living goes up, you have this extra pressure on the government to pay out more money through Social Security, which means there's going to be less and less money in the Social Security fund for the next people or the next generation of people that are going to retire. What that means is you have two different options. Either Social Security is going to run out of money even faster because they're going to have to pay out more money right now to fund the people that are in retirement, or you're going to have to see your taxes go up because the Social Security fund is going to need more money to fund Social Security. So this is kind of a question mark with what's going to happen here, but you do not want to rely just on Social Security income because this is not going to be able to fund your dream lifestyle when it comes to retirement, which is why I don't want you to even think about Social Security. If you're here at the minority mindset, I want you not to think like the majority of people, and I want you to be self-sufficient where now you can rely on yourself and your own investments and your assets to be able to retire and live the life you want without worrying about the government. Now, let's talk about this, your 401k and your IRA. These are tax-deferred retirement accounts that you've probably been paying into for a long time, and you want to pay into these accounts until it comes time for you to retire. The good thing about these is they can be pretty passive. Anytime you get paid, some of your money is going to go right into your 401k or your IRA, and this money can grow tax-free, and now this is money that's just sitting there, growing, and when it comes time for you to retire, this money is going to be sitting there for you to use. What you got to understand about your 401k and your IRA is that your 401k and your IRA were never intended to be your sole retirement funding account. They were never intended to fund your entire retirement alone, yet the majority of people are planning to retire solely based off of their 401k and their IRA. And I guess you can add in Social Security in there as well, but your 401k plus Social Security was never intended to be enough for you to retire. The first thing that you have to understand here is as it comes closer for you to retire, what any financial planner is going to tell you is you want to move some of your money out of riskier investments, out of stocks, and move them into something safer like a bond, because you don't want to risk a market crash happening and then this market crash just wipes away your entire life savings and your entire retirement fund almost overnight. So you want to move it safer into something like bonds, which give you a fixed income. So now you have treasury bonds or regular bonds, and now these bonds are supposed to pay you with a fixed income, and now you have a steady, safe income when it comes time for you to retire, which might sound like good news, but it's not so good news if the price of things around you keep rising. This goes back to what I was hinting at before. The people that are the most hurt by higher inflation are the people that are not financially educated, the people that don't understand what investing is or how to invest their money, because now all you're doing is you're making your salary and now you have to pay all these higher prices of things because the price of everything keeps going up. And it's also the people that are living off of fixed incomes, because now your income is right here. And if the price of things keep going up to here, well, now you're going to have to lower your lifestyle or earn more money to keep living your lifestyle. The other alternative is you just keep your money in cash, but now your cash is being diluted by inflation, so I guess that doesn't work either. Or you keep your money in stocks, and now you hope that the stock market will keep growing. That way now you can keep your money growing with or faster than inflation. That way you don't got to worry about this higher inflation. But then the risk is, what if a market crash happens? Because now all of your money is in paper assets. Stocks are a paper asset. And so if a market crash happens, you could see the value of your entire 401k or the value of your entire retirement fund get sliced in half in just a day. And if that happens, now you can't live that same retirement that you've been working for your entire life. This is where it is more important than ever for you to be using your money the right way. And in this case, the right way means having some real diversification in your investments. That way now you're prepared for anything. You're prepared for the worst case scenario and you're prepared for the best case scenario. And no matter what happens, you will have money in different assets. That way you can take care of yourself no matter what happens in the world. There are 4 main different types of asset types that you want to consider putting your money in. That way you have real diversification when it comes to your money and your retirement. Because when most people talk about diversification, they say, oh yeah, I'm diversified. I have my money in a blue chip 401k fund. I have some of my money in an innovative 401k fund. And so I have different ETFs within my 401k, so I'm diversified. But all of your money is still just in paper assets. All of your money is still in the stock market. So if we saw a stock market crash, it doesn't matter how many different funds you have, you're still all invested into one asset class. And so if you see the stock market crash, all of your funds are going to go down. So when we talk about real diversification, I'm talking about diversification across different asset classes. So if one asset class goes down, you can go back to a different asset class, because none of us can predict what's going to happen. None of us know what is going to win and what's going to fail. So you want to have money in different asset classes. That way you can win no matter what happens. Some of the most popular different asset classes are stocks, real estate, business, commodities, and now kind of in the newer age, we have a newer asset class emerging, which is crypto as well. When you invest your money into your 401k or your IRA, you got money in the stock market. Great. This is a great place for you to invest your money. It's a great place for you to build your wealth, and it's the most accessible way for the majority of people to build wealth. I want you to do that. I want you to have some money in the market, which is great. Now, I also want you to have some of your money in different asset classes. That way you're protected against anything. The next is real estate. So real estate, when you invest in real estate, you're buying a physical property. You're buying a piece of real estate, something that you can see, feel, and touch, and something that you can control. And your goal with this property now is to rent it out to somebody else. So this might be a home, an apartment complex, an office building, a retail building. You own this physical piece of land and real estate. Somebody else is gonna live in or use this property, and in exchange for them living in this property, they're gonna pay you rent every single month. Now with this, you're creating cash flow and you own a hard physical asset. With businesses, this is similar to the stock market, but now instead of just investing in the stock on the stock market, you're investing directly into a business. When you're investing directly into businesses, now what you're doing is you're giving a business money so they have money to grow even bigger, and in exchange, you get a little piece of ownership in this company. So now what you're trying to do is you're trying to invest in something that's creating a product that you love and believe in, that way they have more money to grow, and as they grow, now you have a bigger piece of equity, a bigger piece of ownership, because the value of your equity keeps growing as this company becomes more valuable. So there's different ways that you can do this. You can invest directly into companies, kind of like what you see happen in Shark Tank. You can invest in franchises, create franchises. This is just a way for you to create a different stream of income, because now you're investing in different businesses that are also producing revenue for you. Commodities, this is things like gold, silver. These are things that you're buying for the sole purpose of just having something to maintain its value, its money. Because in order for somebody to go out and mine an ounce of gold, it takes labor, it takes time, it takes effort. And so that physical ounce of gold that you own, it is kind of a representation of the work that goes in to produce this ounce of gold. Similarly with cryptocurrencies, the thing that you have to understand about cryptocurrencies is, one, it is still a relatively new asset class, so it's still very volatile. And second, there is a lot of future application with cryptocurrencies, and there's also a lot of risk with cryptocurrencies, because you have a lot of people that are speculating, a lot of people that are trying to get greedy with cryptocurrencies, trying to get rich quick. But at the end of the day, there's a lot of future with cryptocurrencies, because the future of money is digital, and there's a lot of technology behind cryptocurrency through the blockchain, and that has a lot of value which can be used to transfer data, to transfer information, to transfer money. And so this is a place, again, it's like a property which you can own, and you own a little piece of this thing which you hope will maintain its value. Now, before I go any further, I need to remind you that although investing is the secret to becoming wealthy, there are also risks associated with investing your money, because you are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. You don't need to have your money invested in all 5 of these things for you to have real diversification. But what I'm trying to do is I'm trying to open up your mind a little bit. That way you understand that there's more ways for you to invest your money outside of just your 401k or your IRA. Because right now the issue that most people have is, one, they're not investing any money for retirement, and if they are, all their money is sitting right here or here. So they have no real diversification. They think that, hey, I'm putting 5% of my income towards my 401k, I'm ready for retirement. It doesn't work like that. I need you to think a little bit bigger, and I need you to invest a little bit more aggressively. Yes, this is a great place to start, but this is not the end. This is just the floor, not the ceiling. So you can start here. Then you can open up your own individual stock market account. Yes, you're not going to get the same tax benefits here through your 401k or IRA, but it's another place for you to invest your money so you can invest more aggressively into the market. Then you could think about investing some money into real estate. Maybe you want to buy a rental property. If that's not for you, think about opening your own franchise. Think about investing in a business. If that's not for you, then think about owning some commodities. These things are not going to pay you with any sort of cash flow, but it's kind of a way for you to protect your money. Same with cryptocurrency. If you're a big believer in cryptocurrency, then have some money here, but also don't keep all of your money here. You need to have some real diversification across different asset classes, because every asset class has booms and busts. Every asset class faces its own corrections. Every asset class faces its own crashes. And so what you want to make sure that you're doing is you want to protect yourself for whatever might happen in the future, because chances are our economy could face some weird issues in the next decade. If you want my recommendation, I want you to own some hard assets in addition to these paper assets, because the advantage with investments like real estate is now you're getting consistent cash flow. Once you own a property, once you own a physical piece of building, you own this building. Now it will continue to pay you rent no matter what you do. No matter if you're on the beach in Hawaii or no matter if you're at work, this property will continue to generate your cash flow, because as long as somebody's living in there or using it, they're gonna have to pay you for living in your property. So the advantage here is once you do the work to buy the property, now this property is gonna pay you for years into the future because you own this asset. With stocks, yeah, you can see huge appreciation. You can see the value of investment skyrocket. but they can also go down with the blink of an eye because paper assets can be easily manipulated. I've never liked the idea of retirement. This is more of a philosophical level thing, but I never liked the whole idea of you working until you are 65 years old. So you work from 21 to 65, and then when you turn 65, you retire and you quit your job because you're tired of working here. You don't like your job. You've just been working there so you can eventually retire. And then once you hit that retirement age, you quit and then you go home and then you start living your life, or quote, living your life, which is what people think that they do. Then what ends up happening is you come home, and to start living your life, you go on the sofa and then you start watching TV. Then you watch more TV. Then you watch more TV, and now your time just sneaks by you. I have seen this happen with my own eyes. One of my uncles was an engineer, and he loved his work, and he worked at his job until he was like 67 or 68 years old. And when he retired, he didn't know what to do with his life. So he just sat at home and watched TV all day, and he went into depression and became miserable. And all of a sudden, like 6 months after he went into retirement, he started developing all these physical health problems that he didn't have before, because now he was mentally not feeling good, and now he wasn't taking care of himself or his body because he didn't know what to do in his life. And all of a sudden, it was almost like a day and night shift between him living life and now in his golden years, no longer living life, even though that's when he thought he would start living life. The best thing that you can do right now is start designing your lifestyle the way that you envision it to be. That way you can start planning for this dream lifestyle and start working towards this dream lifestyle right now. Like, I don't ever envision a time where I'm not working. I love work. I love what I do. I enjoy working. If I'm not working, I feel like something's wrong, and so I never want to stop working. But that doesn't mean that I'm gonna be working 40 hours a day every single day, right? You gotta kind of figure out what it is that you like and how do you envision that to be in your lifestyle. If you don't have a purpose or a reason for why you do what you do, you're never gonna have a reason to wanna get out of bed every single morning and crush your day. So what you wanna start doing right now is you wanna start planning. What is it that you wanna do? If money didn't matter, what would you do every single day right now? And start planning for that. Because the way that you can do that is, well, you start generating some cash flow here, you start generating some income here, you start generating some investments here. That way now you have money that you can use to live your life. And as you start to do the things that you do, you keep taking all this extra cash that you're making and putting it towards these things. And when you have that freedom, now you start doing more of the things that you want to do. Because the last thing that you want is you hit retirement and now you don't know what you're gonna do with your life, and you go miserable because you have nothing to do in your life. That's why I hate talking about traditional retirement planning, because I think traditional retirement planning is dumb, where you put all of your money aside and you can never use it until you turn 65 years old. So you're just saving and doing all these things. That way one day, hopefully, eventually, you can start using your money. But I want you to start living and enjoying your life now, which all goes back to now, how are you using your money today and what kind of life do you want to live? Because I want you to start living your life a whole lot sooner than 65. But the only way you can do that is if you start using your money smartly, like a financially educated person today. That way you can live your life and fund your life the way you want, because you were the one that's smart with your money and you're not relying on somebody else to take care of you. Knowing how much money you need in order to live financially free is one of the most important financial questions you can ask yourself. I got my handy dandy whiteboard because today I want to go over how far $1 million can actually go. How you use your $1 million is going to depend on a couple of different things. It's going to depend on how you spend your money, and it's going to depend on how you actually use your $1 million. So let's start by talking about you using your $1 million to live a $1 million lifestyle. If you want to go out and live that $1 million lifestyle, then you're probably going to keep this $1 million in cash in your bank. That way you can access it very easily. And now what you're gonna do is you're gonna go out and you wanna look good on Instagram. So you're gonna buy yourself, let's say, a $500,000 house with cash. That way you don't have to deal with any mortgage payments. And then you're gonna buy yourself a nice $200,000, maybe an Audi R8, a nice supercar. You're gonna go on a few vacations. So there's a plane, looks like a plane. And in a couple of years, you are going to be broke. So if you want to live the Instagram flexing lifestyle, then that $1 million is not going to last you very long. This should be pretty obvious. If you're subscribed to a YouTube channel, you understand that it doesn't really matter how much money you make that matters. It's what you do with the money you make. Even if you have $1 million, you can go broke almost instantly if you don't know how to use your money the right way. And if you're not subscribed to a YouTube channel, you should do that. But this is why so many high-paid athletes and so many high-paid lottery winners end up broke so quickly, is because you make a ton of money, but you don't have any financial education. So what do you do when you make a lot of money? You blow it. Now, when you blow all this money you have a bunch of nice things, that you have no money left. This is the majority mindset way of spending money. You make a ton of money and then you blow it on a bunch of nice things that make you look rich, but they keep you broke. And so this is going to be a big no-no when you make $1 million. Now, don't get me wrong. I want you to own a nice home and I want you to drive a nice car and I want you to go on nice vacations, but I want to make sure you can afford it. That way you have cash to live your life financially free. So let's go into the second way that you can use your money. Now let's assume that you have this $1 million, but you're conservative. You don't like the whole idea of investing your money because you don't want to throw your money in the stock market and see this $1 million get sliced in half if the stock market crashes. So you want to be safe and you just put this money in the bank. This is how I grew up learning about money. I grew up in a traditional Indian house, and Indian people love saving money. It is like in our blood. And so Indian people make $1 to spend 20 cents and save 80 cents. Well, in the American culture, it is very common to make $1 and then spend $1.20 with lines of credit and credit cards and loans. And so Indian people are born with that saving mentality. And so what do? You make money and then you save as much money as possible, and you don't want to invest it because investing is risky. And so you build this huge savings cushion. That way you can live wealthy. Now, saving your money is better than blowing all of your money on nice cars and clothes, but it doesn't give you the full potential of your money because your money is just sitting there flat and is getting eaten away by inflation. In the financial world, there is something called the 4% rule, which says you take your savings and investments and you add it up, and then you live off of 4% of that a year and you adjust it for inflation. So in this example, I'm going to take a modified version of this 4% rule and say that you want to live off of just $40,000 a year, which is 4% of your $1 million you saved up in cash. If you live off of $40,000 a year, then this $1 million is gonna last you 25 years because now you're not investing your money. This $1 million is just sitting in your bank account, and every single year you're just gonna draw out $40,000. So January 1st every year you draw out $40,000 and you live off of the $40,000 for 12 months. If you continue to do that, you will be able to live off of your $1 million for 25 years. After 25 years, you're not going to have any more money. I'm assuming for the sake of this example that this $1 million is just sitting in your bank account and it's not growing at all because right now savings accounts are not paying you anything. So if your $1 million is not growing and you're just pulling out $40,000 a year, then you will be able to live off of this money for 25 years and you will be living a $40,000 a year lifestyle. But this doesn't factor in inflation because, as you know, the value of our money doesn't stay the same. That's why $100 today can't buy as much as $100 could back in 1970 because our money is slowly losing value over time because of inflation. Now, if we factor inflation into this, and now you're not pulling out $40,000 every single year, you pull out $40,000 this year, and then you pull out a little bit more money next year, and then a little bit more money after that by factoring in a 2% inflation rate. Now, you're not gonna have enough money to live off of this $1 million for 25 years. You're gonna have enough money to live off of for 21 years. So if you want to live a $40,000 lifestyle, then you can expect this money to last you for 21 to 25 years, depending on what inflation is, if you have $1 million. Now, if you want to live a $100,000 a year lifestyle, you can just adjust the numbers. So if your goal is just to save your money that you can draw cash out of, well, now you can do the math to see how long this money is going to actually last you. Now, this time, instead of saving your cash, let's say you have the minority mindset where you invest your cash and you want passive income. So you invest your money in the stock market for dividends. And I'm going to give you two different scenarios. Scenario one, you invest it in McDonald's, MCD, or you invest it in IBM. So scenario one, you invest all $1 million into McDonald's, and scenario two, you invest all $1 million into IBM. Now, look, I am just a random guy on YouTube, okay? So don't blindly listen to anything I say and make sure you do your own research. I do not recommend that you take all of your cash and throw it into one stock just because of the dividend. This is just a hypothetical. Some companies in the stock market, like McDonald's and IBM at the time of me recording this video, make a lot of money. And at the end of the year, they have a whole bunch of cash in their bank account and they just don't know how to invest all this money back into their business. And so what they do is they take this cash and they just give it away to their investors, people like you who invest in their stock. So if you go out and you invest in one share of McDonald's or one share of IBM, then you will get these passive income checks called dividends deposited directly into your account. At the time of me recording this video, McDonald's pays a 2.5% dividend, which means if you invest $1 million into the McDonald's stock, you will make $25,000 a year from your McDonald's investment. IBM, on the other hand, pays out around a 5% dividend yield right now, which means if you invest $1 million into IBM, you will make $50,000 a year in passive income from dividends. So you still own your investment, but every year you're getting a check from McDonald's or from IBM for doing nothing except just owning their stock. So you don't have to sell your stock to get these dividend checks. You just own the stock, and then every 3 months, every quarter, you are going to get a check from McDonald's or IBM. Before you go out and you start living this $50,000 or $25,000 a year lifestyle from your passive income, remember, the government wants their cut, so you gotta pay taxes. Luckily, dividend income has a lower tax rate because the government wants to incentivize you to invest your money and get this type of passive income, so they reward you with lower taxes. If you make between $0 and $40,000 a year in taxable income at the time of recording this video, you have to pay 0% of your money in taxes. If you make between $40,000 and $441,000 a year in taxable income, then on your dividends, you have to pay 15% in taxes. And if you make more than $441,000 a year, then you are paying 20% a year in taxes on your dividends. At this point, you might be thinking, why in the world would anybody want to invest in McDonald's where you can only make a 2.5% dividend when you can invest in IBM and make a 5% annual dividend? Well, there's a little bit more to what meets the eye. Over the last 2 decades or so, the price of IBM stock has stayed pretty much flat, and over the last decade, the last 10 years, IBM stock has actually come down about 10%. So if you invested this $1 million into IBM, it hasn't really gone anywhere, and if anything, if you invested over the last decade, it has come down, even though you're making more money in dividends here. With McDonald's, on the other hand, the price of the stock has gone up 5-fold over the last couple of decades, and over the last decade, the price of the stock has doubled. So if you invested this $1 million into McDonald's a decade ago, this would be worth about $2 million, and if you invested into them 5 years ago, this would be worth about $5 million, even though your dividends aren't as big. So you have to understand there's a little bit more to what meets the eye, because there's more to investing than just the dividend price, which is why you do not want to make your investment decisions based solely on this dividend percentage. You want to look at the underlying fundamentals of the company, and you want to make sure you're investing in a company that's growing, that you believe in for the future, because if you do that, then you're going to make a whole lot more money than just this dividend price. Now, past performance does not predict the future performance in any way, but I just want you to understand this, because if you invested $1 million here versus $1 million here, then you are going to make less money in passive income for a little while here, but you could also pull some of your stock out and sell some of your stock and have some cash and still see the stock growth and still see the value of your $1 million grow while having more cash in your hand. In any case, with both of these examples, you have income that you can use to live off of every single year, and you also still have this $1 million nest egg. Now, if the price of the stock goes down, the value of your investment will go down too, but in general, you still have a big chunk of your investment just sitting there invested in one of these companies, and you also have passive income that you can live off of without selling any of your investment. The third thing that you can do with this money is you say, you know what, I don't want to invest my money for dividends. I want to invest my money in the stock market to see my money grow, but I don't know which stock to put my company in, so I'm just going to put my money in the stock market, and if the stock market goes up, my $1 million will go up, and if the stock market goes down, well, I will take that risk. And now what you're planning on doing is taking out a little bit of your profits every single year, or taking out a little bit of your equity rather every single year. And if you have profits, then that's just icing on the top. Now, instead of just keeping your money in cash in the bank, you're putting your money to work by putting it into something like VOO or SPY. These are two funds that give you exposure to the broader stock market. VOO and SPY both give you exposure to the top 500 companies in the stock market. So now if the stock market goes up, your fund will go up, and if the stock market goes down, your fund generally goes down. You can draw cash out just like you could in the bank, but now you have a little bit more risk, because if the stock market goes down, the value of your $1 million will go down too. To put some numbers on this for context, in December of 2010, VOO was trading for around $110 a share, and SPY was trading for around $125 a share. Then in December 2020, 1 decade later, VOO went from $100 a share to around $340 a share, and SPY went up to $375 a share. So both of these funds saw right around a 300% increase over 1 decade between December 2010 and December 2020. What this tells us is if you put $1 million here or here in December 2010, you would have something around $3 million over here. But the issue with that is then you don't have any money to live off of for this decade. So if you live off of 6% of your income now, so meaning in 2010, you take $60,000 out. So now you have $940,000 to invest and you put it here or here, you would still see a profitable growth. That means now you're not taking out 4% like I talked about before, you're taking out $60,000 or 6% of whatever your pool is every single year, and you're still seeing a profitable growth because you're seeing more than a 10% growth on your money year after year after year. So you're pulling out 6%, but your money is growing by 10%, so although you're taking out more money than before, your money is still growing faster than what you're pulling out. In this situation, you have a couple benefits. You get to pull out more cash than you did before, so you can live a bigger lifestyle, and you still have your nest egg, and your nest egg is growing on top of that. Before, when you just saved $1 million, every time you pulled money out, your nest egg grew smaller, so you had less and less cash available. Now you're pulling more money out, but your nest egg keeps growing bigger. Now I know you're probably thinking, but Jaspreet, just because the stock market went up in the past doesn't mean it's going to continue to go up at the same rate in the future. You're 100% right. Maybe the stock market will go down. Maybe it will stay flat. Maybe it will go up faster than this. Maybe it'll go up slower than this. There's no way to predict that, but this is the risk you take from you investing your money. And that's also why more risk comes with more potential reward. Now, I should also mention that when you pull out cash in this situation, when you sell your stock and you have a profit, you have to pay taxes on your profits. That doesn't mean you pay taxes on every dollar you pull out, because some of this money, this $1 million, is yours. So when you pull this $1 million out, you don't pay any taxes. There's lower tax rates that I talked about earlier. If you don't like the idea of owning these paper investments like stocks, and you want to own a tangible physical investment that you can see that will pay you passive income, then you can look into investing in real estate. So real estate is my favorite investment class just because I like the idea of creating passive income through owning a physical asset. I'm trying to draw an apartment complex here, so bear with me. I hope that looks like an apartment. But when you buy an investment like real estate, now you own something physical that you can see, feel, and touch, like this property. And now what your goal is to own this property and put tenants, people into this property who are going to live there or use your property, and in exchange for them using your property, they're going to pay you rent every single month. So you don't have to do any physical work to earn this income, because once you own the asset, you can hire a management company or a property manager to do all the physical day-to-day work, but you will get this passive income every single month because people are living in or using your property, and for them to do that, they have to pay you rent. When I invest in real estate, my goal is to get a minimum 7% annual return on my money. So if you invest $1 million into a property, let's say you buy a small apartment complex, then my goal would be to make $70,000 a year in passive income profits after paying all your expenses from owning this property. So after paying all your expenses, you should be left with $70,000 in your bank account. At first glance, you're making the most money here, but don't forget about taxes, because you got to pay taxes on your income. Now, as an attorney, I can tell you that real estate has a bunch of legal tax loopholes that you can use. Now, although I am an attorney, I am not your attorney, so if you have specific tax questions, make sure you talk to a tax specialist in your area. Now, what you can do with real estate here is you could tell the government, hey, yeah, I made $70,000, but I don't want to pay taxes on all $70,000 because my property is a year older. And so what you get to do if you have $1 million property is you get to take a $25,000 deduction every single year for the next 30 or so years, because the property that you own is just 1 year older. And so you get to tell the government, I'm only going to pay taxes on $45,000, even though I made $70,000, because you get to take this deduction called the depreciation deduction every single year for just under 30 years because you are investing in real estate. And that's just one of the loopholes you get for investing in real estate. So if we calculate this out, if you tell the IRS that you made $45,000 in income from your real estate property, you're going to have to pay around $5,000 in taxes, because you don't have to pay Social Security taxes or Medicare taxes. You only have to pay your income taxes, which means you are going to be left with right around $65,000. You made $70,000, you only pay taxes on $45,000, and you will be left with about $65,000 that you can use to live your life, and you still own this $1 million property. Now, there are some other legal loopholes that you can use in real estate to lower your taxable income even lower, but I'm not going to go over all of that in this video. Hopefully, you'll see your property value go up, which will add some icing on top of this passive income. But when I analyze my real estate investment deals, I'm looking at this, the passive income. I'm not looking at what potential value this could go up to, because I just want to see how much money I can make every single month. As a quick little tip on this, real estate does have more risk because now you have to physically manage this property and deal with tenants and work with property managers and work with real estate agents and work with contractors. So there's more upfront work required, and there's more of kind of like a skill set required, because now you're not just investing in a company like McDonald's and IBM and letting them handle the investment. You are the one managing your investment here. So now if we really analyze how far $1 million can take you, it depends on how you use your cash. If you just save the $1 million, that means you will be able to live off of, let's say, $40,000 a year, and you have 21 to 25 years of money. After the 21 to 25 years, your money is gone and you have no money left. If you invest this money into dividend-paying stocks like the McDonald's or IBM that we discussed, then you can expect to make somewhere between $25,000 and $50,000 a year to live off of, based on today's numbers. And this will last you as long as the company is strong, because now you're owning an investment that will continue to pay you dividends as long as the economy is strong and as long as the company that you're investing in is making money. If you invested this money into an index like VOO or SPY that gives you exposure to the general stock market, then we're talking about something like $60,000 a year based off of the historical numbers that we saw. And again, how long will this last? Well, as long as the economy is growing and the stock market is growing. These come with more risk than this, but there's more potential to make more money. And if you invest this money into real estate, then hopefully, depending on where you live, you should be able to make about $70,000 a year in passive income. Again, these are all pre-tax numbers. And how long will this last you? Well, it depends on how good the area is that you invest in. If the location continues to thrive, then you will be able to make money from that property for generations. But if the area that you're investing in starts to tank and people move away, then you might not continue to see the same rental income that you're seeing right now. You just got paid and now you got a pocket full of cash, and the question is, where do you blow this money? Before you drive on over to the Gucci store and buy yourself a new wardrobe, what you talking about, Jaspreet? I can shop online now. The first key to becoming rich or becoming wealthy or becoming financially free is to use your paycheck and to use your income the right way. That way you can build your wealth first, but that requires you to know how to use your paycheck. This is where everybody says, oh, all you need to do is create a budget. Well, lots of Americans have a budget, but most of those people don't actually use their budget. There's a lot more to what you do with your money than just having a budget and keeping a budget. That's why in this video, I'm going to go through step by step the 7 things you need to do with your money as soon as you get paid. That way you can build your wealth first. The first thing you have to do is have your net income deposited directly into your checking account. I call it your net income because, well, every dollar you earn is not every dollar you keep. As soon as you make money, the first thing that's going to happen is the government is going to take their share in taxes. So whatever's left is your net. As soon as you get paid, the government's going to take their share of taxes. But some of you are going to have the option to invest your money before or after your taxes, depending on what kind of system you use. Usually something like a 401k. So if that's something you're using at your job, this would either be right here or here if you're using a Roth 401k. So as soon as you pay your taxes, you pay your 401k if you have one, then your net income needs to be deposited directly into your checking account. I used to guest teach in Detroit Public Schools, and what I learned there was they had all these kids that were working jobs, but many of these kids did not have a checking account where their paychecks were deposited into. Instead, these kids were getting physical checks, and then they were taking their checks and they would go over to a liquor store, and then they would pay the liquor store owner 1 to 10% of their paycheck to get cash for their own money. So you're having to pay a liquor store owner cash to get access to your own money, and then once they have this cash, half of the check is going to go to Cheetos and pop on the way out. You need your money deposited directly into your checking account, and one of the worst things that you can do is rely on payday loans to make ends meet for 2 or 3 days. The way payday loans work is for every $100 or so that you borrow, your payday loan company is going to charge you somewhere between $10 and $30. Now, this $10 or $30 fee might not seem like a lot of money, but compared to how much money you're borrowing, and that 10 or 30% interest that you have to pay is just for borrowing money for a month. That's why if you amortize the real cost of your payday loans over the course of a year, these payday loans are actually costing you somewhere between 300% APR and 500% APR. Okay, payday loans are destroying your wealth. So create a calendar, know when your money's coming in. That way you can rely on your actual income and not the payday loan. The second thing you have to do is save $2,000 in a separate savings account as fast as possible. This $2,000 that you want to save needs to go in a separate savings account because this is emergency money. This is money if your car breaks down or if something really bad happens, you can rely on this cash to protect you. That way you don't have to go into debt or use your credit card to finance something that you cannot afford. This money needs to be saved as soon as possible because if you do not have $2,000 saved up for an emergency, you are in financial danger. Okay, before they used to say, oh, all you need is $1,000 to start your savings account, but that was like 2 decades ago. Now, if you factor in inflation and the increased price and cost of living, you need at least $2,000 right now saved up for an emergency so you get out of this danger financial zone. The reason I'm saying this needs to go into a separate savings account, not the stock market or any other investment account, is because this money needs to be liquid, meaning in cash, which means easily accessible, and it needs to be predictable. If you put this money in the stock market, well, if the stock market tanks tomorrow and you need this cash, well, this $2,000 might only be worth $1,000. So you need this cash somewhere in a predictable liquid account, like a savings account. That way you can access it whenever you need in case you need it. But this is not money you should be using when Apple releases a new phone. So if you do not have a separate savings account, or if you do not have $2,000 saved up right now for emergencies, what you need to do is you need to open up a new savings account tomorrow, and then next time you get paid, you need to save as much of that paycheck as you can as fast as possible because you need to get to $2,000 saved as fast as humanly possible. Now, as soon as you get paid your net salary, so this is after your taxes, after your 401k investment, this net income that you make is going to hit your checking account automatically. Then what you need to do is you need to save $2,000 as fast as possible in a separate savings account. So if you don't have $2,000 saved up yet, you need to take as much of your net income as possible and put this money into this account. That way you can save $2,000 because if you don't have $2,000 saved up, you are in financial danger. Then it's time for step number 3. Now we're going to pay down your high interest debts. So after you have $2,000 saved up, what you want to do is you want to pay down any high interest debt. So this might be credit card debt, this might be payday loans. So any high interest debt that you have, you want to pay this down as fast as possible right now after you save $2,000 because this money is skinning you alive financially. This money that you're paying 15, 16, 17% interest on is so expensive and it is destroying your wealth. It is making your credit card company wealthy. It is making your hard money lender wealthy. It is making this payday loan company wealthy, but it is keeping you broke. You need to save this $2,000 first because if you don't save this $2,000 and you start paying down your credit card debt, and then your car breaks down, and then you have to pay $800 to fix your axle, well now you're gonna have to go back into credit card debt to have the money to fix the car. So you took a step forward, and then you took 2 steps backward. That's why you need to save some cash first while making your minimum payments, and then when you have a little bit of a cushion, now you need to be aggressive at paying down all of your high interest debts. Once you have this $2,000 cash savings, and once you pay down this high interest debt, and typically this is going to be anything that's not a mortgage, that's not a student loan, that's not your car payments, or really anything that's over like 6% a year. Once you pay this high interest debt down, now you're going to do 4, 5, and 6 at the exact same time. But let's start with number 4. Number 4 is investing 15% of your income. So I'll put number 4, invest. And what you're going to do now is after you have this $2,000 saved up in a savings account, and after you don't have this high interest debt anymore, now what's going to happen is anytime you get this paycheck, you got your net money coming and hitting your checking account, you're going to take 15% of whatever's in there. So for every $100 you make, $15 is going to go into an investment account. So there's a few different ways you can do this, and it depends on what your risk tolerance is. One way that you can do this is you can open up a separate checking account in your bank, and anytime you get paid, 15% of your paycheck can automatically be withdrawn from your checking account here and be deposited here. The reason is you want to make sure this money in your investment account is going to build you wealth. You don't want this money going to buy you a new TV when TVs are on sale. We talk a ton about investing on our YouTube channel, which is why if you have not subscribed to our YouTube channel, you should do that. But there's a few different ways that you can invest this money depending on your risk tolerance. If you don't like to take a ton of risk, one thing that you can do that will give you a guaranteed return on your money guaranteed, is you can pay down now your remaining low interest debt. So that means your mortgage, your student loans, you can use this extra cash to pay down your debt faster, because now if you pay down your student loans 1 year early, you're getting a guaranteed 6% return on your money. Because if you're paying 6% interest to your student loan lender, and you pay it off a year early, that 6% interest you no longer have to pay to your lender. When it comes to paying down your debt, there's a couple of different strategies that you can use to pay down your debt quickly. One's called the debt snowball, and the other is the debt avalanche. The debt snowball method is where now you're gonna pay down the smallest debt amount first. So if you have 5 different debts, one that's $15,000, one that's $3,000, one that's $400, one that's $12,000, and one that's $600, what you're gonna do is you're gonna find the smallest debt. I think that was the $400 one. It doesn't matter what the interest rates are, you're gonna pay down the smallest amount of debt first. That way you can get the small wins. Psychologically, what that tells you is, wow, I just knocked down one of my debts, and now I can go to the second debt and then the third debt. So you're gonna go in order from the smallest to the biggest, and you're going to ignore interest rates on this because your goal is just to get the small psychological wins. This is the method that Dave Ramsey preaches because he finds that this is what keeps people on pace to pay down their debt, because now you're getting those small wins. The other option is the debt avalanche method, where now you're paying down your debts by the interest rates. You find the debt that has the highest interest rate first, and you're gonna pay that one down first because that one's costing you the most money. Now, over the long term, if you can stick to both of these, then the debt avalanche is going to save you more money because you're gonna pay less interest. But if this debt snowball method is what you can stick to, then do that. It doesn't matter which one you do. I just want you to pay down your debt. So if this one works, do that. If you would rather do this one, then do this. You can invest this money to grow your mind. So that means you can use this money to buy books. You can use it to buy classes, to attend seminars, things that will enhance your mind, enhance your financial education. That way you can make better decisions with your money, maybe earn more money. Or if you don't have any debt or you want to be more of an aggressive investor, you can use this money to invest directly into the stock market or into real estate. One of the most effective ways to invest this money into the stock market is to create an automatic passive investment. But now, instead of creating a separate checking account for this, what you can do is create a brokerage account that will automatically invest your money every week or every month whenever you get paid, and anytime you get paid, so you can tell the brokerage how much money to take out. 15% of your paycheck is going to automatically be invested for you every single pay period. So whether it's every week or every 2 weeks or every month, you can decide this. And now this money is automatically invested. You're not even going to see it. Anytime you get paid, this money is automatically going to go into the stock market. And this is going to build another investment account for you that's going to be working to build your wealth without you physically having to do anything, because it's all passive. Or you can use this money to invest in real estate. And when I say real estate, I don't mean a home that you're going to live in yourself. I mean an investment property that you're going to rent out to somebody else. The other option, if you want to be more of an active investor, is you can put this money into a separate checking account, and then whenever an investment deal comes your way, maybe it's the business idea you like, maybe it's real estate, maybe it's a specific stock that you want to invest in, when this money comes your way, then you can deploy this cash as an investment, but it needs to go into a separate account. That way you know not to accidentally touch this money and use it to buy a new TV or use it to buy AirPods, because it's in a separate account that's only going to be used to invest and build you wealth. As you are doing this, what you're also going to be doing consecutively is number 5, saving some money, because now what's going to happen, you have 15% of your paycheck going over here. You also want 10% of your paycheck going here to your savings account. Remember, the savings account is money that you're using for emergencies only, okay? And once you have this $2,000 cushion built up, that's a small cushion, but you need to build that bigger. You ideally want to have 3 to 6 months worth of expenses saved. So if you're spending $3,000 a month, you want to have a minimum, a very minimum of $9,000 saved up. And if you really want to be a big saver, you can save a year's worth of expenses, but I don't recommend really saving more than that, because after that, inflation is really just eating away at your savings. But in order to build the savings account, you need to build a system where now some of your money, here 10% of your income, is going directly to your savings account anytime you get paid. So again, this is a separate savings account, and anytime you get paid, for every dollar you get paid, 10 cents is going to go directly into the savings account. So if you make $100, $10 goes here, because now you are going to automatically be saving money without even thinking about it. And you need this cushion to protect you from any sort of emergency that will happen. That way you can sleep easier knowing that if something bad were to happen, you don't have to go into debt because you have the savings cushion built. Remember how I said the 4, 5, and 6 happen at the same time? Well, you're going to be investing this money at the same time. You're going to be putting this money away for your savings at the same time. And you're also going to be doing number 6, which is spending at the exact same time. So what's going to happen now is, in this account, your checking account, you are now going to be left with 75% of your remaining net pay. So I guess you can call this your net pay, because this net pay was after your taxes and your 401k, and now the 75% is after you paid yourself. It's after you invested your money to build your wealth, and it's after you saved your money to protect you. But this is where you have to be careful, because now you need to know the difference between a need and a want when it comes to spending your money. This is gonna sound like common sense, but as we all know, common sense isn't very common. When it comes to the spending money, you wanna make sure you spend your money on needs before you spend your money on wants. Now, what you need to do is you really need to understand the difference between a need and a want, because that might seem obvious, but people's financial decisions speak very differently. You need a car to get to and from work, but you just want the newest BMW. You need a phone. You just want the newest iPhone. You need guacamole. You just want to pay the store $5 for an extra side of guacamole. I want you to be able to buy and afford all the wants that you want. But you need to make sure you can afford them first, which is why you need to prioritize your needs before your wants. Because if you don't prioritize your needs before your wants, what you're gonna say is, oh, Jaspreet, how do you expect me to save 10% of my income and invest 15% of my income? But then at the same time, you have $450 going to your car payment every single month. You're spending $100 a month on your cell phone, and you're paying $120 a month on your monthly massage membership. You need to know what your needs are and your wants are. Right now, you need to become wealthy, which is why you want to make sure you're paying yourself first by investing your money and saving your money. Now, based off of this money that's left, you need to live off of this money, and the only way that you can do that the right way is by knowing what you need and what you want. Your car, your cell phone, eating out, and buying drinks outside are some of the biggest wants that people are turning into needs. I get it, you need a car, you need a phone, you need food, but you don't need a Beamer. You don't need the newest phone, and you don't need to be eating out 5 times a week. Those are wants that we're turning into needs, and that's destroying your ability to build future wealth. Everybody gives the example of how much money you could save if you just made your coffee at home instead of going to Starbucks. Well, I don't drink coffee, so I can't relate to that, but I drink tea. I like nice teas, and if I want to drink a nice tea, it's gonna cost me something like 25 cents to 35 cents, and we're talking nice teas, for making a glass of tea at home. If I bought the same tea outside somewhere at the coffee shop or at a tea shop, it is going to cost me at least $3 for the same tea. Now, if you're also eating lunch outside, which I know a lot of you are, it is gonna cost you, assuming you're eating healthy, $14 to get a wrap and soup. If you made that same wrap and soup at home, assuming we're using nice, healthy products, it's gonna cost you something like $4. So $10 here and another $2.50 here. $12.50 you can save every single day, 5 days a week, just by making your tea at home and just by making your wrap at home instead of treating this want as a need. And if you just calculate out how much money this would save you over the course of a year, because there's a lot of people that are eating out for lunch every single day, and there's a lot of people that are buying their tea or coffee from outside every single day, that's $2 and some change plus $10 and some change. Let's say $12.25 times 5 days a week times 52 weeks a year, that's more than $3,100 a year that you could save to put towards your investments or towards your savings, just by understanding the difference between a need and a want. This one's pretty simple to understand, but what about those impulse purchases? You're going on Amazon and you see a special deal on a new coffee maker, or you see a brand new deal on a new massage gun. What about that? Well, one of the things that you can do to help understand the difference between a need and a want, and really think about these purchases before you actually spend money that you don't want to spend, is using something called the 24-hour rule. The 24-hour rule just says that before you make one of these impulse decisions, breathe and tell yourself you're going to wait 24 hours before you make that purchasing decision. You are gonna find that you're gonna stop yourself from buying a whole bunch of unnecessary crap that you're never going to use just by thinking about it for one day. All right, so I just cleaned this up for you so it's easier to understand. You started by getting your net income after paying your taxes and your 401k money. Once you get that, the first thing you wanna do is save $2,000 in a separate savings account. Once you get that $2,000 saved up, then we're getting rid of all of the high interest debt. Once you got this high interest debt taken care of, then you're going to be investing 15% of this money. This money is going to build your wealth, whether it's through education or paying down your debt or investing your money into stocks or real estate, something that's going to help build your wealth and your financial freedom. As you're doing that, 10% of your money is also going to be saved in this separate savings account That way you have a cushion to protect you from any sort of financial emergency. That way you can sleep easier knowing that even if something bad happens financially, you are going to be okay because you have savings. And then you are going to keep 75% of your income in this checking account as you're spending money, but you're going to understand the difference between a need and a want, and you're going to spend your money on needs before you spend your money on wants. That way you don't come over here and say, oh, Jaspreet, how do you expect me to invest my money when all of my money is going into my Beamer? Now it's time for number 7, to buy your time back. Listen, at the end of the day, it doesn't matter how much money you have or how good your financial system is if you don't have the time to actually enjoy your life and to enjoy your money. Okay, this whole time so far, we've been talking about how to build this system. That way you can use your money as soon as you get paid to build this financial freedom. But now you also need to be thinking in the back of your mind, how do you actually enjoy your life? And the way you do that is by buying your time back. That way you can do more of the things that you love, because now you're going to have the money to do it, because not only are you going to know what's a need and what's a want, but you're also going to be earning more money because your investments are going to be working to build your wealth. So now as you're building this financial freedom, you need to know how you can actually enjoy your life. This is where you have to figure out where your time is getting the best ROI, the best return on investment. Okay, at the end of the day, we can always make more money, but we cannot get more time. The amount of time we have on this earth is limited, so you want to make sure that you're using your time in the best way possible. So you want to start by figuring out what things do you hate doing and what things do you wish you do not have to do anymore. Is it cooking? Is it cleaning? Is it getting groceries? Because guess what? These things you can outsource. You can hire somebody to cook for you. You can hire somebody to clean for you. You can hire somebody to get your groceries for you. You just have to make sure it's worth your time. Right? If you're making $20 an hour and you can get somebody to clean your house for $10 an hour, and that would save you 4 hours a week, well, you can just buy your time back by hiring somebody to do that. It's the same with cooking, and it's the same with getting groceries. Find the things that you hate doing. And now, as you're building your wealth, start to use your money to buy your time back. That way you have the time to do more of the things that you love. Plus, on the flip side, once you have the system, now you can start calculating, okay, it's going to take me 35 years to where I want to be financially. But if I want to shorten that time, what do I got to do? Well, one thing you can do is get a better return on your money. Or the alternative thing that you can do is earn more money, because if you're putting more money towards your investments, towards building this wealth, then you can reach that financial goal quicker. And so if you want to earn more money, now you can think, okay, you can either work harder at your job to get more hours, you can get a promotion or a raise to make more money, or you can look for a new side hustle, start a business, take on a side job. There's a lot of different ways that you can earn more money. But in order for any of this to be possible, you need to have a clear picture of how your money is being used. That way you can get the best return out of your money and your paycheck. Hey, do you remember what happened with the whole dinosaurs and extinction thing? Yeah, but what does that have to do with my money? Well, if you keep managing your money with old money rules, then your wealth will become like dinosaurs. You mean it's gonna be huge? No, it's gonna be non-existent. Look, 50 years ago, there was no internet, and there was no cell phones, and there was no Uber or ride-sharing services, and there was no YouTube, so I wouldn't know you. Times have changed, our economy has changed, but the things we're taught to do with our money hasn't changed one bit. Like, if you are following that old dinosaur traditional money management model, you will have to work until you're more than 100 years old to have enough money to retire and finally start living life. You're probably thinking, what does a random guy on YouTube know? Random guy on YouTube? Where? According to USA Today, millennials born after 1981 will need $1.8 million to retire. This isn't a super lavish retirement. This is a healthy retirement where you can travel and enjoy retirement. And if you want to live a very lavish lifestyle and have a bunch of nice things, well, you're gonna need more money. But going along with this example, you need $1.8 million to retire. And what's the traditional financial planning model that the majority of people teach? The 10% rule. Let me read you what the 10% savings rule is. This way, we're on the same page. According to the balance, the 10% rule, or 10% savings rule, says that you should save about 10% of your income for retirement so you can retire. This is traditional financial planning, and yes, many people follow this 10% rule of just saving 10% of their income so they can one day, hopefully, eventually retire. Well, if you make $50,000 a year right out of college when you're 21, and to keep things simple, let's assume this $50,000 figure is after taxes, and you follow this 10% rule, what happens? Well, you're gonna save 10% of your income, which is $5,000. And if you do this, it will take you 360 years to retire. Check my math. I mean, $50,000 a year times 10% is $5,000. And $5,000 times 360 years is $1.8 million. Looks like we're watching Jurassic Park this week. Okay, so this model is a little drastic. I mean, most people aren't making $50,000 a year right out of college at 21. But seriously, all jokes aside, this example is a little bit extreme because it's assuming that you're gonna make the same salary for the next 300 years. So let's look at something a little bit more realistic. I'm gonna be nice and say that you continue to make $50,000 right out of college after taxes, but this time you negotiated a deal with your boss. This way you get a 3% annual raise every single year to keep up with inflation. So this year you make $50,000 after taxes. Next year you make $51,500. The year after that you make right around $53,000, and so on and so forth. And you're continuing to save 10% of your income. So this year you save $5,000. Next year you save $5,150. The year after that you save right around $5,300. When you do this, you will be able to hit your retirement figure of $1.8 million much sooner than the previous example. The bad news is you'll be 104 years old when you have enough money to retire. So I guess we're watching Jurassic Park again. Clearly, this 10% dinosaur traditional savings model is not enough to help you retire. And if you're thinking, but wait, Jasprit, I have a 401k. The 401k by itself is not enough to help you retire either. And I've even made some videos on this, and I'll link it in the description below. That way you can watch these videos after you finish this video. So now your question is probably, okay, Jasprit, if dinosaur financial planning doesn't work, what should I be doing? Good question. Well, there are two things I want you to do. First, you have to create a financial system or a budget that works for you. And second, you're gonna have to fuel your financial system. Let me show you what I mean. So let's start with how to come up with a financial system that works for you. If you have a family or people relying on you financially, I want you to follow our 75-15-10 plan, which says that you can spend a maximum of 75% of every dollar you make. Then you have to invest a minimum of 15% of every dollar you make, and you have to save a minimum of 10% of every dollar you make until you have 6 months worth of expenses saved. After that, you should stop saving and invest this money too. By the way, if you have debt, you can use your investment money to pay down your debt early because paying off your debt is a type of investment. If you're younger and you don't have any financial responsibility, then this is your time to build, and you should be following our 50-30-20 plan, which says that you should only spend a maximum of half of what you make. Then you will invest 30% of what you make minimum, and you will save 20% of what you make minimum. I know this is hard and it sucks, but this is your time to get a running start on building your wealth. Don't throw this opportunity away and become a dinosaur. So if we go back to the example from before, you make $50,000 a year after taxes. Now, under the first scenario, you get to spend a maximum of $37,500 on yourself, and you will invest a minimum of $7,500, and you will save a minimum of $5,000. You're living a little bit smaller, and you have more money going to your investments, so you can get to your retirement number sooner, which is good at all. But for you minority mindset thinkers, this isn't gonna be enough. You have created a financial system, and now you know how to save, you know how to invest, and you know how to spend. And this is where the majority of dinosaur financial planning stops. It's just live smaller and smaller and smaller until you can ultimately have enough money put away to retire. But if you have been watching our YouTube videos every single week, you know that we're not like the majority of people. I mean, that's why we're the minority mindset. Once you're here, now it's time to fuel your system. When you're making $50,000 a year, the maximum lifestyle you can live is a $37,500 a year lifestyle. But what if you could bump your income up to $500,000 a year? This is where things get interesting, because now you will be living a $370,000 a year lifestyle, and you'll have around $100,000 every single year to invest. And if you do this correctly, you'll have more money coming back next year. What? My boss isn't gonna give me a $450,000 a year raise, Jaspreet. What are you talking about? Well, the great thing about being alive right now, besides the fact that we don't have dinosaurs running around trying to bite our heads off, is that we have so many opportunities to earn more money because of the internet. I have met high school kids, teenagers, making over $100,000 a year from their Instagram page by selling products. And this is something they're doing in addition to going to school Monday through Friday. Like, the internet is a free tool that can allow you to market your brand or to sell your products to the right people anywhere around the world for free or for a fraction of what it would have cost you to do this 20 years ago. But if you want to start capitalizing on this opportunity, you have to start thinking different. Is it going to happen overnight? No, it is a ton of hard work. I mean, you're going to first have to learn how it works, and then you're going to have to try things, and then you're going to make mistakes and screw up, and then you're going to have to learn why you screwed up, and then you're going to have to fix it and do it again and again and again until you finally figure out the system. If you're just starting off, it might take you a few years before you get any real traction. But once you get going and you start to figure out the system, then it's just a matter of scaling what you're doing. You become a penny pincher. You stop going out to Starbucks. You stop buying nice things. You stop going on vacations. And this is where the majority of people get stuck. They assume that you have to keep doing this forever if you want to become wealthy. They become penny pinchers and couponers for the rest of their life, and they never want to spend a penny because they want to become wealthy.